Muted.
All right. Well, thank you everyone for joining our January webinar. This is our first one of the new year, so hopefully everyone is kind of well rested and back at it after a good break. Today's topics because we didn't do one in December because of kind of everyone on vacation. We sort of asked, just for everyone to send in their different ideas, what they had, if you had a challenging case and you wanted some recommendations of how to present it in LDA. So we sort of crowdsourced this webinar, and it's a little bit of a mix of some of your ideas. One of the general themes that we saw was a term to permanent conversion. So we're going to cover that first. The other thing we saw a lot in our survey was basically doing cascading or layering insurance and showing basically maybe how we can make an insurance plan for an individual with changing needs. And again, when we think about a lot of our clients, I think it's probably very typical that changing need as we grow older, we might want to reduce some of our coverage. Now, some people, again, have different, sort of the state things and they want to increase their coverage, but this one was more focusing on how can we layer insurance and make an insurance plan. The other topic we're going to cover is basically a credit to the CDA comparison. Where, again, this is more for the corporate market for business owners who are owning insurance and really, leverage that capital dividend account. And we're going to show a couple examples. It's a new feature in there. We had a couple, actually, requests for policy withdrawal or loans. We're going to show you how you can illustrate those, and I'm going to talk a little bit about what I'd like to do with development going forward. So, again, I might ask, the community's feedback as we go forward with this. I'm going to preview our interactive case share and some of the updates there. How you can share your interactive cases with our Premier package with your clients, and actually get notifications on things like when they view it, or how long, and even get a sense of how engaged they are with, sort of what you've presented. Give us secure means and way to comment back and forth with your clients as well. So, if you're not familiar with our software, again, I do encourage you to sign up for the 30-day free trial. If you are signed up with us already and taking a look, this is great training. I'm showing off now our new Premier package again, which is a brand new package. So previously we had our Elite one. Do get in touch with us and let us know if you're interested in some of the new features. We're more than happy to kind of preview some of them. I'm going to cover as many as I possibly can today, but I know we do have a packed schedule. So I'm going to get started on basically our first concept, which is one of the best uses of life design analysis, and that's really our term to permanent conversion. So again, a lot of people, especially even for the corporate market, will place a term policy to, one, lock down that insurability and at least establish a business relationship. And the ultimate goal of some of these policies can be to convert them. Could be even after the first 2 years. Sometimes you just get the term 10 policy in there and again try and convert it immediately. A lot of times though, we have to show the benefit of why someone would convert a policy. When we go from term 10 that can be extremely affordable initially to something with a much larger sticker shock. And sometimes using the visuals in our system is the best way to really communicate that long-term value. And the whole reason being is that a visual is processed almost immediately, whereas text and numbers, if we just look at the number 1,000 versus 30, we go, okay, well, I'm taking the lower number. I'll worry about that bigger number later. And so we tend to put it off where we need to make an impact with these clients. So I'm going to set up a brand new case here, and I'm going to actually make a new client in the system, and I'm just going to call this guy webinar test. I can give it a corporate name, and I'm going to leave the birthday blank. I'm just going to fill it in. I mean, he was 19, actually, I'll fill it in. He was 1978 here. And I'm actually, because this one is a policy review, we're going to do it on a real policy that I've pulled. So this is actually from an existing contract using all real numbers. And again, this is a male non-smoker. If they were a smoker, just check it off here. And again, this this concept works with any different age of client, whoever has bought a term policy. It really can be any different year. I mean, the big thing is our age in years. There is some additional contact information there that I could populate, but for the sake of brevity, I'm just going to save our new client. And again, a webinar test is actually going to be in there forever. So if we ever need to make another case on this particular client, we can. I'm going to hit continue, and basically this is going to transition us into the design of the case where we can really design anything, any kind of product comparison. Of course, this one is going to be our term to permanent. And you can see my client here is actually 39. They were 34 when they bought the policy. And and it is a Term 10 policy that they purchased. So just really quickly, I'm just going to show where I'm getting these values from. I'm using a second screen, but this is basically the policy that I'm going off of. And again, I blanked out all the kind of the critical information about this actual client, but I just want you guys to see that this is an actual policy. It is existing. Again, issued for a 34-year-old male. The face amount is actually a little bit larger. It's a $2 million policy. So again, this will be a great conversion to have. And again, it's not all that, it's not issued all that long ago, but it's, again, 2012. So I guess, time is really clicking away. And I guess, that's one of the main things we want to highlight to our clients is that, we buy these Term 10s, we think 10 years is a long time, but it really does fly by. So this is going to be the policy I'm going to review here. And I'm basically going to show, I want everyone to pay attention to this is the premium schedule that we're going to compare on a guaranteed basis. Now, when you actually go to illustrate these, I mean, there's many different approaches you can take depending on your clients. I really prefer to actually punch in these exact guaranteed renewals when I'm doing a review for a policy, because then if I need to use it in the future, of course, I've got them in our system. You can illustrate these other ways, though. So, I mean, some people would say, well, he's young enough that he might reissue that term up until a certain point. And again, that's going to take some risk. Of course, he's going to have to remain healthy, which is probably not going to be an issue for the first couple of renewals, but it may come as an issue a little later on. Just so you know that you can issue these as renewals, I'm going to be using this guaranteed schedule today. And again, if you don't have the guaranteed renewal schedule, I'm also going to show today a really quick way to estimate and give kind of a conceptual representation. So again, we're going to pay attention to this renewal schedule, but this is basically what I'm going to be using to review the policy for an existing policy. So without further ado, again, I want to put in, the first thing I want to put in here is our $2 million insurance benefit. I'm just going to punch that in there just to specify that's the face value we're looking at. Now, again, as a lot of you are familiar, you can search the market for a variety of different products. We're going to use kind of the search to replicate these rates when I illustrate if you don't have them. But because I do have that policy contract, what I'm going to do here is I'm going to select from our plus manual area, and I'm going to select a Term 10 policy. And you can see the name at the top, and again, this is what's going to appear all throughout the report, in the legend, in the tables at the very end, is Term 10 by default. But these are all editable by you. So, I mean, feel free to get creative. I always say whatever communicates to the end user or your client the best is really what you want to use. So, like as an example, I could say, this is rented insurance. So a lot of people say this is rented versus permanent is owned. So feel free to get creative. I mean, a lot of times we focus on certain companies, but we might want to focus on more of a concept. What I'm going to do here is I'm going to say this is your existing Term 10. And I could give an extra description, if I wanted to say a Term 10 is something that renews every 10 years, it has a guaranteed renewal schedule, we could also reapply. You can give any sort of additional details in there. We can also enter, as you can see, the initial premium schedule. So again, as I showed you before, I'm going off the one in this policy, which started at, for the first 10 years, was actually exactly $1,000. Basically, what I want to do is I want to enter any subsequent renewals. So I'm just going to show here again, I'm just taking the schedule from $1,000 here, and I'm going to enter all these renewals at every 10 years intervals. And again, our system knows based on that, we've picked the Term 10 form that each one of these renewal periods is 10 years. So I'm just going to punch in 5140, and then the policy renews to 12,460, and then it renews to 33,780, and then it goes to 99,940, and finally it goes to 208,720. Now again, for those interested in that rewrite concept, we have a great video on our YouTube channel. Basically, instead of entering in guaranteed renewal contracts, what we would do is we'd search for them at their increased age and enter it in there. Now, this product is actually one renewable till 85 and convertible to 75. Now, when you do this, it'll tell our software exactly when to, sort of stop the policy when it expires. It'll also put a nice little green X saying that your conversion option has expired when you put that in there. Maybe one of the most important details about this, though, is the issue date. And this one, again, was issued in 2012. So again, I'm going to put that this was 2012. And it was actually issued in April, and it looks like 20th. So I'll put in the actual issue date. And I'm not going to put in the real policy number here. You would put in the real policy number in one of your presentations. But essentially, the real important thing is the issue date. So once you enter an issue date in our system, again, it recognizes that some of the time that this first 10-year renewal has actually passed, and we're going to adjust our calculations and say we're actually that much closer to a renewal because of that issue date. So once I put it in there, I'm actually going to save it. And you can also save these to the client file as well. So if you ever need to use these in the future, you certainly can. And again, it really saves time in a policy review situation. So I mean, you might do this now. Let's say they don't take action, but you want to review it again next year. That's when you can go back and say, look, let's put new product on for pricing. But again, because we have the issue date in there, it's always going to be able to recognize exactly when this policy was bought and what the current date is. Now, this particular concept is term to permanent. So one of the strategies we might want to use is something like, a minimum funded UL. We might start there. So I mean, it doesn't have to be a full conversion to permanent. Let's just search the rates, though, and actually see what turns up on the market. Now, most of the time, I would say search all companies. This particular product that I pulled was actually a Canada Life one. So I'm actually just going to search the Canada Life rate. It's the only one I'm interested in from a term conversion point of view. Again, feel free to search the whole market or suggest other term products. Of course, if you're doing a term renewal for, say Manulife or London Life, you're going to use that product in there as well. So I'm going to say add the case and add this Universal Life here that we've added here. And we're going to do basically a comparison of that term product and how that plays out over time. And first, we're going to do it against a UL, and then I'm going to add a whole life after that. Now, once I add my two different products, I mean, again, it was really simple to add that. It didn't take very much time, and I've already got my comparison done here. So essentially, all I have to do is actually hit Generate Report. There are some different controls, though, underneath. So, I mean, sometimes you may want to tweak a certain element of the case. Like my general rule of thumb is that if you're comparing any sort of permanent product, that you set the age out to 99. And part of this is that I want them to see the big picture. Of course, people are living much longer these days due to medical increases, but I really want them to see that that term policy is going to expire. So I do put it out to age 99, so we do see that. Again, if you're focusing on a short-term need, you may want to kind of tighten that time frame up there. And that's what the only change I'm going to make to this one. Basically, I want to generate this report and see what it looks like. And again, this would be, I think, a fantastic compare for really anyone. You bought this policy, and this is kind of the path that you're on, versus maybe what a conversion to a UL would be. And again, this is going to give them permanent insurance. It's also going to be something where they don't necessarily need medical evidence. So again, if someone's unhealthy, these are great strategies as well to put in front of them. Again, these kind of conversions, a lot of times they don't necessarily need a full conversion either. So there's lots of little contract loopholes that I would pay attention to as well for partial conversions. Again, you can see that we're actually about 5 years into this term policy. So we've got 5 more years of that nice kind of $1,000 premium, and then we're going to hit those renewal schedules. And again, what we really want to illustrate is that, as I think my stepfather said it best, he said, term insurance is like a diaper, and at some point you're going to have to change it. And what we really want to emphasize is that no matter how many times you change it, even if I illustrate this as a rewrite, that we may want to consider permanent insurance for the cost benefits. And sometimes it does seem like, it's a lot more initially expensive, but again, it's, insurance is one of those things, it's quite like anything else where you do get what you pay for. Now, looking at the annual premium schedule, this is essentially our first chart where we're just kind of outlining the cost. And what I really like about this chart and kind of these comparisons of term versus permanent is that the renewals of the term policy, and it doesn't matter even if we rewrite this, because at some point, again, they're going to hit where they can't actually purchase insurance anymore. But again, what we're really going to see here is that these term renewals, particularly in these later years, are actually going to really put into perspective what happens to our insurance policy. So you can see right before it expires at age 85, and I think about 50% of people will actually exceed age 85 who are in this demographic. The policy expires itself, but it really puts into relation. If we thought this UL was expensive at $17,000, how are we ever going to pay $100,000 a year? It just simply wouldn't happen. We would actually cancel the insurance. So I really like to focus on the client's age when I go over something like an annual premium schedule, and I say, do you really want to think about at age 64 trying to apply for new meds or being potentially stuck with a premium for $33,000 only to have that product renew again and ultimately expire on you? And this one's a really good one to take someone through the pattern of how a term policy works and how it operates over time, even in a rewritten scenario. The next one I really like is, again, an addition of all the costs. So that's, again, this is a really simple visual. It's something that really helps sell a lot of insurance, is being able to see ultimately, what is the best cost for insurance for me? And again, this is, I think, a fantastic comparison. When we look at the UL, yes, initially it's more expensive. This is really the power of the visual, though. We're going to look at the big picture. We can actually absorb and see that break even. Again, if you're going to live to 75, they're kind of a wash. You may want to pick the term. If you're going to live past that, which I think most people would agree that they would, it's clearly evident that the UL here is a lot less expensive. And again, that's ultimately the point we're trying to make. You know, we want the clients to have the best possible insurance for them. We want them to not have to deal with kind of those tsunami renewals. And we want them to see that ultimately, you know, a plan that's in place until we stop having to pay at age 99 may be the best solution if we need permanent insurance. So again, I think it's a great compare. Whenever you have two products, again, a really nice kind of comparison as well is just kind of looking at that, the sum of premiums and the difference between them. So again, if I take this client out to, you know, say we call it life expectancy here at age 84, again, I'm going to save them $750,000 by picking that plan that, you know, maybe initially looked more expensive, but again, in the long term of things was actually a better product for their needs. So again, I really like to focus on our time frame of how we can show. I should have put $2 million in there. Someone's saying that the insurance benefit. Yeah, I've got $2 million. Okay, good. So another one, you know, that we might put in there, we've got our existing term 10, we've got our universal life. Another one we might want to compare to is something like whole life. And again, we could use our universal life and actually leave it in there. We could also take it out as well. So I'm going to take this one out. I really like the two product compares for actually looking at the difference of premium versus some of the cash values and things like that. So I mean, feel free to leave as many products as you think are relevant in there. In this case, I want to put in a whole life comparison against this existing term 10 here. So I'm going to say let's add a whole life. I'm going to use, again, Canada Life Whole Life because this product specifically was a Canada Life term product that I was putting in there. All right, perfect. And you can see with any whole life, again, we can search rates through those life guide rates and get guaranteed value. So if you're doing a fully guaranteed plan, that's fine. What I really recommend, though, is using actually the spreadsheet from the insurance company software. So I'm just putting a Canada Life plan here. And again, you can design really anything you'd like within the insurance carrier software. You can see I've got my client in there. Again, they were 34 when they initially bought this coverage. And what we can see here is that they're 39 now based on their current DOB. I've got the coverage here, again, set at $2 million, and I'm using paid-up additions. But again, any different dividend scale is going to work. If you're not doing a full conversion as well, feel free to use term riders or ADO if you're really trying to kind of max out that contribution to the policy. So really design it any way that you're comfortable with, or that you're, you know, that really kind of highlights the values that you're looking to portray. But as I say, I'm using an estate achiever 20 pay. I'm not using any kind of additional funding or anything like that. I'm just using that straight guaranteed 20 pay. Now, all I really have to do is actually hit View Data to see kind of the digital fingerprint of this plan. You can see it's a $50,000 premium, which is actually a pretty nice premium because it does land somewhat close to a round number. And I'm just going to export this to Excel. And basically, again, as I said, this is kind of the digital fingerprint of the plan. It gives us every kind of detail from our NCPI to ACB and everything in between. All we have to do, though, is basically hit this little button in the kind of in between A and 1. There's a little button at the top left of our Excel sheet where we can actually, and I'll just pull up my little highlighter here. And if you just see right around here, there's a little kind of button in the top left corner that you can actually click here. Get rid of my tool here. And I'm just going to click that and say select all. So again, that's a great way to select everything of that spreadsheet. All we have to do, though, is right click and copy everything. I'm going to say copy that. Now, once I've copied the spreadsheet, again, I've got all this information, so I don't really need it anymore. I can actually kind of minimize that and get rid of it. You can also save the entire spreadsheet if you want. I'm using the copy-paste method, and I'm going to paste the entire quote that I've created. Now, it looks like a lot of jumbled numbers. That's okay. We're basically reading the headers in the spreadsheet. So again, it doesn't matter where the column actually shows up. We're going to read that and bring it in. As you can see, it's been imported successfully. And I'm actually going to close out this old window here and not save that spreadsheet. Now, just like we did with the term 10, giving it your existing term 10, we can actually edit this Canada Life Whole Life and say, you know, it's not just whole life, it's estate achiever, and we can give it like details like a guaranteed 20 pay, So any kind of description that kind of helps our client understand. Again, you can give even more details about, sort of what you've designed, if you've done anything special in there, like offsets or ADO, things like that. I'm going to save the title, and again, what we're going to do is we're going to look at, sort of the Term 10 versus the Estate Achiever, and this would be, again, a full conversion of that Term 10 to the full paid-up edition PAR plan. Again, this would be a great sale for sort of any kind of client who can actually have the cash value to support this. So I've got, again, our logo here. So imagine this with your own branding and things like that. Again, client name is in the report. Let's kind of skip into the meat of it. We've got, again, our existing term policy here. And even things that, I always say recognize things about color really speak to the audience as well. So when you show these to your clients, we use something that's, kind of like the stoplight system. So red is your term. Because it's existing, it's a little bit more cautionary. It's closer to its renewal and it actually expires. Whereas green is a PAR plan, it's a whole life, and again, it does have cash value. So again, we kind of color coded accordingly to help, kind of bring out some details of these plans. Again, when we go through the annual premium schedule here, a lot of people, I think, a $50,000 premium versus the $1,000 that they're paying right now could be quite a shock to the system. Again, when we don't see any value, and we're just, so price sensitive because we see all these different commercials out there about, get the lowest price for your insurance. We really want to communicate value. So again, I really like, when we think about someone this age, again, if we talk about it, so think about your age as we kind of go through the chart here, and think about, your plans for retirement. So when you're 59, I guarantee if you pay that premium all the way through, that your premium will go to zero at age 59. So a lot of people think about retirement at 60, 65. I think the boomers are starting to think about it a little bit later. We want to stay active. So again, this is quite a young client, but again, it's really important to think about our premium going to nothing versus actually accelerating and going on and on. Again, when we do that sort of cost comparison, even though we have funded this whole life plan for 20 years, and again, it is a large premium, it just really kind of highlights how that term renewal actually does creep up on us. So again, when we look at the break-even point here, again, we can see age 79 or in 40 years, that's actually when we break even in premiums. And again, from there on out, that whole life is actually less expensive. And again, we can do this as a rewrite. It's going to be a lot, our break-even point is going to be pushed out. And again, it's really going to depend upon that last kind of renewal there. But it's a really kind of neat comparison to just show big picture. Again, a very simple visual here, just showing here's the costs. And I always kind of liken this to, do you want to climb the mountain when you're younger, or would you prefer to try and climb the mountain when you're older? Again, I think we want to do it when we're younger and actually capable of putting aside that kind of money and planning for it. Now, the other thing that is really important about doing these term conversions is highlighting, why we put in all this additional deposit. Again, I really am going to focus on 20 years here with this estate plan, because I want to show, even though there is a large premium deposit difference, that there's some value for that. So again, we really want to highlight that with our charts. And this one is, again, specifically focused on that PAR product. This is the Estate Achiever that we're focusing on today, and this is total cash value. So basically the way this chart operates, and again, it's very simple for our clients to look at it and see exactly when we break even. So again, we can see in year 18, we actually have more cash in this policy than we've paid in premium. So basically red here equals any penny that we've put into this policy. So the sum of all premium deposits against that total cash value. So again, this is the non-guaranteed total cash value. Some important things about our software, and again, really handling objections really well. I mean, this is I think it's a fantastic chart because it shows, your deposit in relation to how the values build over time. And again, it's sort of that visual concept that really puts those things in perspective. Now, a lot of clients can fire back and say, is this guaranteed? Of course, you have to say, no, it's not a totally guaranteed number. It's based off a dividend. Now, we can, though, objection and say, we want to look at the guaranteed cash value. So I'm just clicking on the legend here. So I'm clicking on the guaranteed, and that's, again, another advantage of bringing in that spreadsheet is that you're going to have values, for those certain things. Now, we wouldn't often rely on the spreadsheet or on the actual guaranteed values for the most part. I mean, they've issued a dividend for the last 130 years, but it is important to some client to have those guarantees in the contract. So you can see here, after 20 years, I've put in basically $1 million. And if I want to find, I just kind of scroll over here, and in year 28 at age 67, I could actually guarantee this client, if they cashed out, they would get all of their money back. So again, it's a guaranteed 20 pay and a guaranteed cash value at age 67. is equal to the premium. So again, it would be basically a net nothing cost to them. You know, as I said, you know, a lot of people don't focus on those guarantees because how steady these plans are, but it is really important, especially in a low interest environment, to focus on some of the reduced values. And again, that's something I really would highlight to the client as well and say, look, it's more likely, rather than rely on a guarantee, that we would see a reduced dividend example. Now, my example here is 1%, but as you can see, I'll show you that you can actually customize from the illustration software which reduced example you'd like. So if you do want to show this at -2 or -1.5, that's completely possible, or even both in our system. Again, I can get rid of premium and say, look, here's the difference between it performing at its current dividend versus 1% less. And again, there is difference, but even in relation to those premiums that we put in, you know, at the end of 20 years, we're still, even in a reduced situation, we're still going to have all that money to leverage. So again, it's a very powerful way to handle objections, and also I think give more transparency to these kind of products. So, you know, when people are comfortable with the products that they're purchasing, especially such a large purchase decision, it really can help. You know, Lemur says a lot of policy sales are actually derailed by the confusion in the industry, and some of these visual charts can really just help simplify that concept of, you know, how a dividend performs, what happens if the market doesn't do so well, or the investments, and again, really nice visual to show value, not just cost. Now, again, I don't want to just focus on cash value. After all, we are talking about insurance here. So, you know, another very powerful visual is just showing how that paid up addition works. Again, starting at our $2 million mark here, and just growing that insurance over time. So again, we can see, you know, it's grown to 5, and this is, again, significant growth. But relative to the premiums we paid, again, we're seeing significant value. We're going to see a great IRR. Take them out to life expectancy here. You know, we've got 6.5 million projected. We want to look at the reduced examples as well. So, but you know what I mean? Still a fantastic growth. So 4.5 million, even in a reduced scenario, starting with that 2 billion. And again, a lot of people like to do these with PVs, like if you PV or present value for inflation. Again, it can show some inflation protection, whereas term would you know, be eroded because of its level face value over time. So again, great way to take your clients through kind of how paid up addition works. Again, referencing sort of that lemur of the jargon and the confusion, seeing something build is a lot easier to understand visually than talking about perhaps a paid up addition. So again, another great one. You know, this one does touch on the credit to the CDA as well, so I've got that defaulted in my metrics. I'm actually going to touch on this a little bit later in our next you know, our next two comparisons. And again, just looking at time, I'll have to kind of speed through a couple of them, but bear with me here. So hopefully, you know, again, we don't feel it's too fast. You know, a lot of times if we do hear that, we do record all these webinars, so this will be available on our YouTube channel after. And again, if you need individual coaching or one-on-one examples of these, certainly get in touch with us. Getting into kind of the meat of the compare, and this is what, again, I really wanted to focus on, that here is our term schedule. What I wanted to focus on, I said, was the 20-year mark. So I said, you know, even though there was a big premium deposit difference at that time, and again, as you can see, whenever there's two products, we're going to get cost of one plan here, $118,000 for the term 10, $1 million plus for the estate achiever. But so that, you know, basically the difference, or exactly the difference between those two plans, was $882,400. And what we want to show right beside that is, you know, yes, we did pay a little bit more into this policy, or, you know, a lot more, depending on, you know, kind of your perspective. But what we got for that, and the value in that premium deposit difference, actually reflected in a $1.2 million total cash value in the policy. So again, not only have we got more cash in the policy than the premium deposit difference, there's actually a gain on that. And as we kind of go out towards time, even in a rewritten scenario, we're going to see that, you know, eventually actually we're saving the client some money here. So, you know, for a $17,000 savings, we actually have close to $4 million in cash in that policy. And again, I think this is a very powerful positioning of showing, you know, what that actual difference goes towards, and how the impact and the efficiency of the cash value inside the policy. And again, let's not ignore that insurance benefit, showing how it grows. We'd have just the level base in that term 10. Again, a couple other, I'm just going to touch on this really quickly here. This is basically a alternate investment. And again, it's one of our metrics that we've always had in the form of a table. A lot of people said, can you do it in the chart form? So we now have available a alternate investment chart. And again, this would be the investment in the market at net 2.5%. What it does is it matches the exact whole life premium, and it runs it against the cash value in the policy. And again, what we want to illustrate is that the total cash value is going to exceed that that alternately invested net interest rate. And again, this 2.5 again is completely user adjustable, so you can set that net rate to whatever you'd like. Again, there are things like cost per thousand or internal rates of return. And again, these are, fantastic comparisons. Take someone out to life expectancy, and again, you can see the estate achiever here of the permanent plan far exceeding, that term policy. And again, sometimes if you're dealing with a CA or something like that, they go straight to that IRR. So again, really fantastic. This metric is also available in the table. So, that's sort of my sample case for a term to permanent conversion. But again, get creative with these. So again, it doesn't have to necessarily be a full conversion. It could be, partial conversion with a term rider, which is sort of going to take us into our next case. So I'm going to actually create a new case here. I'm just going to go again. I'm going to rely to my sample client, Old Faithful. This is a 50-year-old male, and someone at age 50, they may have a need for permanent insurance. They may still have a need for term coverage as well. And again, they're going to see that evolution of their changing lifestyle. So they might want to see that initial high insurance benefit to cover, all the kind of the liabilities. Maybe they've got a lot of debt from sending kids through school. Maybe the kids are still living at home. I've seen a lot of stats on sort of kids living at home and relying on their parents and the financial impact that causes. Whatever the reason, a lot of people do have changing needs. So what we want to do is basically create a plan for them. Now, for this particular plan, I'm going to use a Equitable Life product. And the reason I'm using Equitable for this compare is, within their software, as I said, you can design anything you'd like. One of the things I do like, though, is that you can have two different riders on. So I can have a Term 10 rider and a Term 20 rider. Now, any different software from the carriers, again, there's a couple different ways to layer different coverage. One of my favorites, though, is sort of the idea that, again, our needs change over time. So we're going to design a quote here that kind of fits those changing needs. And feel free to adjust the balances as you see fit for your client. I've started basically with a rule of thirds. So I've got a third of this. So I've got $333,333 of permanent 20-pay estate coverage. And that's going to be my big permanent base. It's probably going to contribute to the majority of the cost of this policy. My client, again, as I said, is a 50-year-old male. So that's kind of what I've designed as Old Faithful there. Now, I'm, again, doing paid-up additions. But, again, feel free to get creative with these with, kind of those economies or enhanced dividend options. Those can really help a cash-conscious or a cash flow conscious client, because, again, they're going to significantly lower our premium. Now, again, what I've done, so I've got the third of the permanent base. I've designed a third to be a Term 10 rider. And, again, because our client's 50, you can see I'm basically designing it so we don't see renewals on these term policies. I have them dropping off after their specified term period. And, again, the reason I don't want that guaranteed renewal, we could always top up or purchase more insurance at that time, but I really don't want to see those renewals in there. So that's basically how I've got my quote set up. Again, same sort of process. I mean, I know it looks a little bit different in each different software, but there is almost always a view spreadsheet button, which will give us all the values of this policy. And again, I think this one's, it's again for $1 million death benefit with a lot of that, a third of it being par. Again, we've got a fairly good guaranteed annual premium. So let's export this to Excel. It just says if you've got one out there, don't do it. Again, override it. So we've got our 20-pay schedule. Again, none of our policies are actually going to, kind of go over that different period. We will see at 10 years, though, the premium will actually drop. And again, I'll kind of highlight that in our software because that term rider is falling off. So I'm going to export that. And again, I'm just using the copy and paste method. So I'm just copying from Excel and I'm going to paste that entire spreadsheet in our software. And again, I'm going to upload that. Again, really easy process. If you're looking at this for the first time, again, I know it looks like a little bit, and I will show that you can search whole life as well, but it's really valuable to get all those different values and all the things you can create in the software. Again, just for the sake of time today, I'm not going to edit the name. Normally, I would edit this until, I've got a third of base, I've got a third of Term 10, and a third of Term 20, and I kind of illustrate that they're coming off there. When you put this in front of your clients, again, make sure that you kind of give it extra details and things like that. It really helps in that communication process. Let's just generate the report and take a look at what this one looks like. And again, the primary thing that I really want to focus on in this one is I want to look at the insurance benefit chart, or that nice blue chart that shows kind of the changing needs. So I've referenced it already twice, so apologize if I'm sounding like a broken record, but that the Lima study about jargon, when we talk about term riders and things like that, again, they become so second nature to us in the industry that we may not even realize that that's sort of the thing that kind of leads to some of that confusion. I'm just going to come down here to our premium schedule. So again, as I mentioned, the first 10 years, again, our software really helps break this out. The first 10 years, the premium is going to be $13,711, and then we're actually going to see it drop, and that's because, again, the term 10 policy for that third is dropping off. Again, at the end of 20 years, our term 20 rider is also going to drop off, but so is our payment schedule because we designed it with that guaranteed 20 pay. Again, you can set up one plan. Like I know we compare a lot in LBA, but we kind of call, if you're doing a single whole life product here, we call it almost a showcase of value. So again, you don't necessarily have to do a compare. Sometimes just doing the presentation of a whole life product this way can be really impactful to your clients. Again, it'll show them, the total cost into the policy is about $250,268,000. We're going to see nice cash value. And again, the thing I really like about this strategy is that we do have short-term coverage, and we do have those term riders in there, but ultimately what I think clients really like to see is that what they've paid, they have at least some value for that. And I think they really like the idea that, if I did cash out, that I would get something back for all those premiums I paid. I mean, we don't usually ask that even about our P&C insurance. We pay into car insurance, and we don't expect anything back. But for some reason, life insurance is like that. We want kind of that safety valve or that exit just in case. And again, there's so many advantages to this cash value, having it there. If you wanted to leverage it, if you wanted to take a policy vacation or something like that. Again, you'll talk to your clients in your particular markets about all those advantageous elements of the cash value, but what they want to see is just how it relates to what they're paying. And again, sometimes seeing this kind of break-even point and seeing that the cash inside the policy actually exceeds what they paid really helps them kind of get that value sense. They can really see that what they're paying towards actually got them something. Again, we can still look at guarantees, really strong guarantees in this product. Again, we're going to see that net kind of, I always think about this as kind of the net cost to my client. And again, a reduced values as well. It's still going to be quite strong. Again, Equitable really strong in those reduced values. So really important to focus in on them. But again, as I said, most of my time I'm going to be focusing on kind of this cascading or this staggered insurance plan. And we might focus on, again, feel free to play with these different kind of elements of how much permanent versus term you want in there. Again, I think this one's really good. And again, I'm going to focus a lot on age and say, as we come through, again, at year 10, we can actually see that rider dropping off here. And again, I'm just going to bring up my drawing tool again. If you're comfortable with the PDF, again, I've seen lots of people say, make notes. So again, you could take out your pen with a client and just kind of draw and say, here's where that term rider drops off. And again, in 20 years here, again, pay attention because now our term 20 riders dropped off. But even though we have these gaps, again, watch how that paid up insurance keeps growing. So that's that permanent base kind of always fueling that insurance benefit. So if I just get rid of here our drawing tools and say trash that, again, you can kind of take them through those different changing needs. But ultimately, at the end of the day, that little $332,000 of permanent has actually grown up to be quite a lot of insurance. Perhaps enough and ideally enough for this client's goals that they've stated. I mean, it's almost $1 million by life expectancy. So, they had that coverage short term. As the kids matured and maybe got out of the house, they didn't quite need as much, or maybe some of it was for the mortgage and they paid that aspect of it down. Again, paid up addition is still growing. Our term 20 comes off after a longer period of time and again continues to grow. Now, again, I just want to show another way to layer because you don't necessarily have to do this necessarily in the actual quote itself. Sometimes you're going to want to layer different kind of products that may not offer riders, or you may want to layer some CI with some life. Again, I just really want to show if we do add, say a term policy here, and I'm just going to do 10-year term. I'm going to use our life guide rates and search. You could also use our combined plans, and again, I'll just use SSQ. Again, I love their rate. Really like them as a company as well, so I'm going to add their product to the comparison here. And again, it might be something where you really like someone's term. I've heard lots of advisors say sometimes they uncouple term riders because all of a sudden if a client can't pay for the the whole life premium and there's not enough cash value to take a vacation there, they don't want the term rider to go down as a result. Again, I just want to edit this and say, this was specifically $1 million here. So I want to actually give this a unique insurance benefit here. It's actually $999,000. I'm going to save that. So again, if you wanted to, again, and you didn't do it, now I've got a little bit of, I've got my kind of Frankenstein here of my, what I used to call trifecta, a little bit of each type of insurance. So again, feel free to layer with UL, whole life, and some term. talking to an advisor the other week, they actually mix different whole life policies, which I think is a great idea to kind of diversify, the different dividends that can go out. But again, I can combine these into one policy, and then again, when we hit combine, we select the policies we want. They get highlighted in blue, and then we just hit save to combine. Now, basically, when we use this combine plans button, what it does is it just sums any of the values, any of the premiums, all into one new plan. Again, you can rename this, so you can, again, it doesn't have to be Equitable Life plus SSQ. It can be edited to be whatever title you'd like. You can also see the old plans, and hopefully this shows up well on the screen share. The old plans stay there, but when we generate our new plan, we're going to have, kind of a different way to layer. So there's kind of two different ways that you could do a layering of your insurance. I'll just kind of quickly generate this one to show. Again, it's just going to be kind of a wonky renewal schedule because we've got, some term in there with renewal schedules now. So it's going to kind of go all the way out. And when we come down to our insurance benefit, again, we're going to see we've got, additional insurance in there. Now we've got almost $2 million of coverage, but it is going to fall off. So at age 84, again, now we're back down to just our permanent base. So different ways to layer there. Really interesting ways you can kind of coordinate those different balances. So I'm going to jump right into our next concept because, again, I still have a lot to cover. I'm going to do basically a policy loan or withdrawal. So, again, I'm actually going to use, I'll just go with our sample client again and do a new one here. Now, again, kind of covering on that topic of anything you'd like at all can be illustrated. Let's just pull up our client here that we did. I'm just going to close these ones out. We're going to pull up basically the client we did who was age 39. So what I want to do is, because I'm using a sample client of 50, I'm actually going to override their age. Again, this can be used to change age. Normally it's used for forward dating or back dating, but we can completely override the client birth date if we'd like. So I'm just going to set them to 39 as per my quote here in Concourse. And, again, I've built a $2 million coverage. I don't have any term riders. I don't have any ADO, but one of the ones we did get requests on is how would you illustrate a policy withdrawal? So this is something, again, we're working on. I will just say, look, you can do the maximum level, and I'm just going to say let's take out the maximum from year 21 to 30. So again, this is a 20 pay. Our client's a little bit younger, but we're going to say we're going to actually take a policy loan. And you can see that, again, if we go into this view data spreadsheet, we're actually going to see the amount of loan that we're taking out here. It's just kind of buried over in these numbers here. But, as you can see here, our maximum loan is about $100,000. We're going to take it out from year 21 to 30. Now, basically, again, the same sort of concept applies is when we, look at our quote, we've designed it again, we've got that same premium we worked with before. We're going to export it to Excel, and again, I'm actually just going to grab this and copy it. Again, bring it in here. And again, I'm going to say add a whole life. We pick the specific company that we're actually dealing with. In this case, it's Canada Life. And we're going to paste in the values here. So again, as I say, once you do this once, again, it gets really easy. But again, it is really quite flexible. And again, this one has our maximum policy loan within it. Now, another interesting experiment, actually, because I think it'll be interesting. So I'm going to say Canada Life policy loan. I'm going to save that. Now, I would give that details about what kind of loan it is and what it's been designed as. But just for curiosity's sake, let's take a look at how a policy loan and non-policy loan kind of illustrate in our system. So I'm actually going to add another Canada Life plan here. I'm going to get rid of our spreadsheet with the policy loan, and I'm actually going to go back to our quote here and basically design one without a withdrawal. So again, this is taking withdrawal from the policy. We're going to take that away, so I've eliminated that. Now again, same sort of process. This quote, of course, does not have the loan, so I'm going to export to Excel, grab all that information, and copy it. Again, you're going to come back to our plan and just paste this one in here. And again, this is a great kind of exercise to see, again, sometimes you will vet different strategies. This morning I was working on a Sun Life policy that was 10 pay versus their 20 pay. And I've been comparing some of the new 8 pay products out there too. So, again, interesting to do some of your research on this and see the, kind of the differences in these plans and how they react to some of these, riders, withdrawals, ADOs, those kind of things. So I'm going to say without loan. And again, I just do this to kind of, again, for my client, I'd probably put a different kind of description. But for us, I'm just going to do it just so we can keep organized here. Now, one thing, I mean, I'll probably leave in all the charts. Now, if I was actually presenting this to a client, I'd probably take out the individual cash and insurance benefits and only show the overlays. That's probably where I'll focus mostly on with us. But just for the sake of it, so we can examine each one individually, I'll kind of leave all my metrics on there, and we'll take a look here. So I'll generate this one here, and we'll take a look again at some of these differences in basically how a policy loan can be illustrated. A lot of it, again, as I say, I would add in the details about, sort of what's being done. Now, we've got two kind of identical policy deposits in here, and again, two identical sum of premiums. What I did want to show, though, is, again, we can see almost immediately we've paid in the 20 years, and then we start taking the loan. So do you see that cash value actually decreasing? What I'd like to do is actually do a stacked bar chart. So again, I do want to surface the community's feedback here and see, what you guys would be interested in. Do you do a lot of policy loans? Is this even a concept worth exploring? But essentially, we would show the loan in a stacked separate value. So again, you'd see the total, but you'd see what portion of it's the loan. Right now, we basically show the cash value going down, but of course, that is money in the client's pocket. So that's where I'd again describe, $100,000, or basically ours was $100,000 going out for 10 years. And then again, after that period, we're going to start to see that insurance policy grow again. Now, the other one we did was just basically without loan, and of course, that's got all the cash value in the policy. Now, one of the neat things with this, and I'm going to go down to insurance benefit, which of course is going to be impacted on an individual basis, and without the loan. But as I said, I really wanted to focus on some of those overlays, which was just going to show basically the difference, and all that difference in the cash value year over year is basically coming out in that form of that loan. So again, that's, kind of a great visual to see not only, the money that was taken out, but what's possible with these products. So that's kind of one of them over there. Now, this is, again, a great opportunity, and I want to leave some time, so I've got about 10 minutes for some housekeeping at the end. So I want to show our interactive case share. So, looking at some of these different ones, I'll actually go down, and I'm going to look at the credit to the CDA to show you how this can be done as well. Basically, it's extremely easy to use. Like any of our metrics, you just check a box at the bottom if you'd like it to be included. And again, this is really for the corporate market. So, when you're doing sort of different options for your business owners, sometimes they wonder what's better, overfunded UL or whole life. And really, their main focus is, leveraging this kind of benefit tax-free. So the corporation pays for the premiums. And again, they wonder what the taxable benefit is. Well, basically, our credit to the CDA metric takes that total insurance benefit, and it subtracts the adjusted cost basis from it, or the ACV. And again, it's going to vet it out. And this one, again, is identical up until that point here at the end of the 20 years where we start taking up that policy loan. But again, this is a fantastic comparison to do, whether you're, especially if you're in the corporate market. But again, if you're looking at overfunded ULs versus whole life, again, different policies, and especially different whole life policies, have a wind down of the ACB at different periods. So if you're in competition for a corporate case, make sure we're looking at the credit to the CDA if they're going to leverage that, because these different types of policies and the way we design them really impact the ACB, which can really impact that credit to the CDA and when we're going to get it. So again, if you could prove your strategy has a better credit to the CDA, even if the values are very similar, it really depends on that ACB. So do vet your policies and compare them in life design to see those differences. The other thing is, we came up with this Premier package, and one of the anchor features was sharing. So, a lot of these charts, the big value is that we can actually move our mouse over and see the values at different years. We can see reduced examples of either policy, and again, equally important when kind of making decisions based on our clients' wants and needs. Now, as always, you're still able to generate a PDF and print this off and show it to your clients. It's great to have that professional image. I still really like the PDF because people do like to hold things in their hands. However, a lot of the times we want to share something with our client, but we can't always get in front of them. So, we may meet with them and exchange ideas, find out goals. We might have had a product to show them, but we find out something new about them that's important, or we want to tweak what we've shown them, or they ask, what about ADO, or I'm trying to shelter even more money. Well, our clients are busy people too, and sometimes we want to share ideas and go back and forth, but we can't always get to them. Again, another example might be a term policy where we don't necessarily want to drive across town for a $34 premium, but we do want to share some ideas and get some feedback from our client about their needs. Well, right at the top, if you're with our new Premier package, you are going to see this case sharing button. And basically what happens is when I hit share, it's going to create a unique link to this case. Now, the link is something that you can distribute to your client. So again, you could email it to them, you could text it to them. There's many different kind of methods that you could actually get this to them. But the whole idea is, again, it creates a unique link to this case. So when I copy this link, and again, I'm just going to pretend I'm sending it to the client. So I'm opening up basically a new window here, and they've clicked on the link. And as I say, when they open the link, they're only able to see what you set up. So they're not able to make any changes towards the time that you've compared things or even what products you've compared. Again, this would be basically the client view that we're looking at now. So again, they can download the PDF, or if they're French, they can, of course, our whole system is bilingual, so they can turn the report into French. What I really want to show, though, here is, they can interact with this report. So again, I've shared this case with them. They can't change any options, but they can interact with things like our needs analysis. Or again, they could interact with things like the annual premium schedule. And they could interact with things like the cash value in the policy, seeing those guarantees, and actually engaging with what you've sent them. Now, one thing you'll notice that's a little bit neat about this is when they're in this case share, so again, imagine I'm the client here in this situation. If I want to make a comment, again, I can click comment and say, this is great. So I can actually comment back to my advisor here and say, this is great. So again, this is the client contact. Now, if I want to call them and ask them a question, again, I've got their number right handy here in the sidebar. So again, if you're familiar with our software, you know that these are little shortcuts to get to your cases and things like that in our system. But a client looking at the case wants to be able to get in touch with you, the advisor. So again, in your account settings, when you put in things like your phone number and share a case, this is going to, again, directly link the client to you as an advisor, so they can more easily get in touch with you, ask you questions. Now, again, it's a very great way to interact with clients, especially busy clients. The other really neat thing about this feature is, again, I'll get out of the client view here, so I'm going to exit out of this. Now, we're back to the advisor side here. Again, when we send our clients cases, watch what happens. So I'm going to go back to my main dashboard, back to my case design here. And again, I just want everyone to pay attention up top here. All of a sudden, I have a brand new notification. And I'll just show you here really quickly. When a client views that shared case, it's going to notify you. So again, you can see I just got a notification the instant that my client actually viewed that new case. Again, I can click on view, or I can say, okay, that's great, I've seen it, hide that. Let's go to view, and again, it's going to take us right back to the case that the client viewed so we know which one it is. And if you take a look down here into these shared case statistics, this gives you actionable insight into, basically how you can know what your clients are looking at, and you can know how engaged they are. So you can see, I just shared that case. I have one visit there. I clicked on 9 items. So again, more clicks, more engagement into those charts. And again, we're building up the reporting on this side, so you're going to know even more details as we kind of evolve this feature. You can see, though, again, I was on that case for 2 minutes and 37 seconds. That was, of course, my average because I've only been to it one time, and that's my last view as well. So let's say we put together a big proposal for our client. We send it to them. We want to know exactly when we should follow up. Well, we're going to know based on how much time they spent on the case and how many times they're visiting it, and sort of different things that they're engaging with, how we want to follow up with them. Again, you can see the client has commented, this is great. We could always comment back and say, okay, great, when can you meet? And we'll add that comment back. And again, we're going to have a record, so the client can always edit their comment. We can always edit the comment and comment back and forth. And basically, again, it's a little bit more secure than email because email is not a secure form of communication, where ours is fully secure and fully encrypted. So again, it's a great way to kind of document. Again, you keep all these notes with the case as well. So a lot of this is from, I position it a little bit as a sales tool, but there are some compliance aspects to this as well that are really phenomenal. One is, again, once our client has viewed the case, we actually have proof of exactly when they visited and viewed and made comments. We have a record of those comments too. So again, really can be a nice compliance asset as well. So that's kind of one of the new features. Another one that we added is buy term invested difference. And again, it really works for whole life or really any plan with cash value. I'll show that really quickly because that is an important update. I'm just going to add a term policy, but again, as I touch base on it, you can do these term rewrites, or you could even use a universal life or a term 20. I'm just going to use this RBC term 10 here and just grab it and put it in there. Now, you don't necessarily even have to illustrate, I could hide this from the report. The reason I added the term 10 though is because I want to use it in my buy term invested difference. So anytime you go into, let's say, for instance, a Canada Life without the loan, I can go into my edit plan here, and I can select the plan in which I want to invest the difference against. So as I said, I don't necessarily have to use my presentation. We just added it because we want to use the data from it. So I can say this one will be my invest the difference plan and save that. And it's probably not that groundbreaking what this metric does, but it is a really powerful metric to use and can really contribute to different sales elements. So basically it's taking the difference between this Canada Life whole life and the term premium and saying, what if we invested that money in the market? Again, just like any of our metrics, you can control the net rate of return for that buy the term invest the difference. So again, our net rate is 3. And again, when we generate the report, it's going to kind of analyze and view, what the difference between that term policy and the whole life premium is, invested at 3% year over year. And again, it's a great metric to show that really the strength of those whole life plans. Now, I'm running out of time. I've got 5 minutes kind of left, so I did want to cover some, kind of housekeeping kind of items that were new. I showed one of them, which was the client case share sidebar and the last time on visits. One of the other things that we've got a lot of feedback on that we have updated is some of the Life Guide defaults in the system. So again, those of you new to the system, Life Guide rates are integrated in the system, and we actually give a 50% discount to Life Guide subscribers. So if you are using Life Guide and thinking about the system, you don't have to choose between one or the other. They work very nicely in conjunction with each other. I will show, though, in the Life Guide tab, a lot of people who do present monthly, our system kind of or do different health risks and things like that. Maybe you deal with younger clients. Our system had defaulted previously to annual, and now you can actually set some defaults in there for your Life Guide settings if you want the rates to always be annually or monthly, or if you always want it to search monthly. So if you take some time, go back into your Life Guide settings and kind of customize them. It'll allow you to sort of maybe customize it a little bit better for your brand if you're always doing monthly. One of the other things that was really neat that we did also add, got a lot of comments on, could we add custom pages in there? So a lot of people started using from the account settings, in that case design, there is an area for, internal notes, report notes, but, some of the mission statements and disclaimers got quite lengthy and took up more than a page. So we were asked, could you add a custom note in there? And so we basically added a page in the report that you could leverage that's a custom note title. So I'm just going to say this is a compliance page. Just put that in there. And I could actually add an entire compliance page. So I might put, all my compliance information. And this, again, would be in addition to that mission statement that I have. Again, sometimes those specific notes got kind of broken down. I'm just going to add a report note in there and check that off. And again, you can basically title this page anything you'd like, generate the report, and that's going to all of a sudden become a page. So, send in your suggestions, again, on this as well. If you can think of great ways to use this, custom pages that you'd add in there, let me know, because, again, I'm always looking for, kind of new topics for these webinars and things we want to put in there. So, again, we've got our custom page, and I'll just show, again, we always have the regular mission statement that we put in there, but we can have a compliance page with specific custom information. So, again, get creative with this, put your extra information in there. Maybe it's some members benefits of certain products, like, again, Foresters has some members benefits that I know, it's not just about cost in some of those situations, so they want to add some of those benefits in there. This is a great place to add those benefits. So again, that was one of the other ones. And again, on the topic of notifications, again, I showed some notifications in there, but there are more notifications. So things like policy opportunity notifications are now in there. So you'll start to see those trickle out as those sort of milestones and those term policies start hitting. Basically, it's going to notify you when a policy, specifically a term 10 policy, is over the 2-year kind of clawback mark, but it's still under the 5-year from issue date mark, so that you can look at the exchange opportunities. It's going to notify you when term policies come within 3 years of their renewal, so term 10, and 5 years within the renewal on term 20. So you will start getting notifications for the Premier package on some of those policy opportunities. So you'll start to see them trickle out. Again, they're all based on importing your clients and managing your clients. So if you haven't done this yet, again, definitely import those clients. You're going to get lots of useful insights as to client birthdays, policy opportunities, and case share views. So that brings us right to the hour. What I would say is if you do, usually in an open forum with this many people, it's hard to get questions in there. So I usually leave a little bit of time at the end. If there are some questions on the live chat, yes, I see there's actually kind of been passing along, but feel free to submit in any questions over the live chat. I'll try and answer any that we can right now. If not, as I say, send your feedback to charlie@lifedesignanalysis.com. Send in your suggestions for future features. Send in any future kind of topics that you'd like covered on the webinar. But I just want to thank everyone for participating. We'll get all of your CE credits out to everyone who registered. Again, make sure you put in your email if you're looking to actually get those CE credits. I do see a question. You didn't show the buy term invest the difference. I'll go back to that last case and I'll just show kind of, again, I've got it checked off here as our table. We've got buy term invest the difference. Just make sure it's checked off here. I've got it there. Buy term invest the difference. And let's go take a look at what that looks like. Sorry, if that's Brian. So I'll generate this case here. Now I didn't actually hide that term plan, so it's going to be in there. But again, as I say, you can use that if you want in there. Again, against our two options. And I'm just kind of scrolling down here to the buy term. Okay, so here's our invest the difference. Again, I've got it going at 3% here. But again, essentially it's taking the difference between the term policy and the whole life premium and running that difference at a 3% accumulation rate. And again, as you can see, after 20 years, you may have 1.2 million in there. We actually have our insurance grown to 3 plus already 1.2 million. And as time goes on, if we think about leveraging this maybe around age 70 or something like that, we have lots more cash in that insurance policy than we would in that term policy. Now again, a lot of people will say, make that more competitive. Don't just take those guaranteed renewals. Fantastic. Get creative. Use the term rewrite. And again, rewrite those term premiums. Use that as the data. You could even use a UL and say, here's the difference between a UL and the whole life, invested the difference. So get creative. Send me your feedback. And again, let me know what you think. And Trevor, I see the email in there. I'll make sure Melissa gets that. So any other questions so far before we wrap it up today? All right, well, send in your feedback, and again, I really appreciate everyone paying attention today. Hopefully you've got some ideas on how you can kind of get going forward with different ways to use LDA to increase your SYC. If you're brand new to the system, again, sign up. We do have lots of basic webinars that kind of walk you through some of the general how-tos to get familiar with some of these concepts as well. And again, we have individual training, so if you ever want a refresher or a case review, again, don't hesitate to get in touch with us. Again, we want to thank everyone for joining, and hopefully we have some exciting content for you next month. So pay attention to that date. Again, take care, everyone, and have a great afternoon.